Today, deleveraging despite low rates and booming housing markets. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour. The end of the working month heralds another set of credit stats from both the RBA and APRA. The RBA reports via their credit aggregates, which is all credit stock in the system, while APRA reports on the banks, or ADIs, and also provides some individual lender loan stock data. And whichever way you look at it, credit growth is still anemic as the great deleveraging continues, and given the weak credit impulse, home prices may also be growing more slowly than many are claiming, although that is another story for another day. Despite the bounce in sentiment after the May federal election, which removed uncertainty about tax policy for the sector, and the RBA lowering rates since June by a total of 25 basis points, although of course not all of that got passed on to mortgage holders, and APRA has eased mortgage serviceability assessments, credit is stuck in the doldrums. And yet I find it amusing that many of the commentators on the sector are talking about lending for housing turning a corner. Well, perhaps, but for now it looks like a turn into a blind alley. The RBA said that housing credit growth overall was 0.3% higher in October, compared with 0.2% in September. This translates to an annual rate of 3% to October, compared with 3.1% last month, and compared with 5% just a year back. That is the weakest result in the history of the series, dating right the way back to the late 1970s, and is below the previous cyclical low of 4.4% in mid-2013. Monthly owner-occupied lending rose 0.4%, while investor housing lending was flat. Personal credit fell another 0.6% in the month, and business lending was down 0.1%. As a result, total credit rose just 0.1%, down from 0.2% last month, and broad money was higher though, which raises an interesting question. Where is the growth in money supply coming from? Perhaps the RBA can tell us. Over a rolling 3-month view, owner-occupied credit grew 1.3%, while investor credit was down 0.2%, other personal credit was down 1.8%, and business credit was up 0.6%. Again, on this basis, there is very little to show a bounce, and in fact it looks more like that there was a spike after the election, but things are easing again now. And looking across the rolling 12-month view, housing credit growth dropped from 3.1% to 3%, with owner-occupied lending at 4.8% and investor lending down 0.2%. Business credit was at 2.7% and personal credit dropped by 4.7%. As a result, total credit was just 2.5%, as low as it's been for many years, although broad money rose 4.2%. Turning to the APRA series, their new data contains a number of surprises. Total lending stock by the banks rose to $1.73 trillion, up 0.2% in the month. The share of investor loans continued to fall to around 37.2%, and this is explained by investor loan stock falling by 0.21% in the month, compared with a rise of 0.44% for owner-occupied loans. The series still looks a bit weird, so we wonder if there are still reporting issues which may explain the sawtooth profile. The individual bank stocks of loans varied, with CBA extending their book, consistent with our industry research, as one of the easier lenders at the moment, along with Macquarie, both of whom grew both investor and owner-occupied pools. NAB and ANZ dropped investor loans, but extended owner-occupied loans, but Suncorp and Westpac dropped both investor and owner-occupied loan balances, assuming, of course, the reporting is correct. Let's see if we get a reversal next month. Finally, market shares hardly changed, with CBA still the largest owner-occupied lender and Westpac the largest investor loan provider. The big four still dominate, but some of the smaller players continue to hold their ground. But it seems that a number of the regional banks, however, are just getting squeezed. Given the weak credit growth, this puts into sharp contrast the reported rises in home prices. We know transaction volumes remain low, but our industry contacts suggest a stronger pipeline of applications. But despite this, the runoff of existing loans is translating to low net loan growth. Even then, loan growth is still strong relative to income growth. But actually the most significant element is the fall in business credit, as more sectors come under pressure. For businesses, the economic backdrop has become more challenging. The global economy is slowing and household spending is soft. In this environment, business investment in the real economy has lost momentum across the non-mining sectors, which will weigh on credit demand. And these results appear to be at odds with the RBA's glass half full view of the economy and may indicate more weakness in the GDP outturn next week. Meantime, sassy households are paying down debt to prepare for the economic storms ahead, and in the current climate, that, my friends, is a very smart move. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.